Today we have to talk about how hedging works with futures. We heard already that futures are similar to forwards as they are used to either buy or sell an asset forward. There are a few differences though, which you should read again on page 24 of the text. As you can see, it says that forwards are individually tailored, whereas futures are not, they are standardized. Especially one of those differences refers to the delivery date or the expiration date. As forwards are tailored individually, futures are not. Futures have predetermined expiration dates. This might pose a problem for traders if futures with matching expiration dates are not available. We come to that later. A perfect hedge means future contracts are available that match quantity and quality and the expiration date for the hedging of the underlying transaction. Though a perfect hedge is rather the exception than the rule, we need to look at a typical scenario to see how this works. We go forward to page 44 and see the situation is explained in detail on this page and on the following pages. Let's start with the situation of the farmer. Suppose he knows in March that he will sell his wheat in October. So he is long in the underlying. He's long in the wheat and he would hope for high spot prices in October, which are denoted as T1, T plus 1. In March, denoted as T, the spot price in T plus 1 is a random variable. It can go up or it can go down, and there's no way to know that in March. If the price goes down until October, he will lose on the wheat. The spot price in time plus 1, the S T plus 1, is his revenue from the sale of the wheat. If the price goes down until October, he will lose on the wheat. To profit from a decline in the market prices, he enters a short position in futures. A short position profits from declining prices in the underlying. So now he has two positions. He is long in the wheat and he is short in the futures. Let's take a look at time T plus 1. The ST plus 1 is a revenue. He is selling his wheat for that price. The FT is the price for which he has to sell wheat in the futures market. So the FT is also a revenue. At expiration, the futures price for that exact moment, T plus 1, cannot be anything else than the spot price. So in this case, we see it's FT plus 1, but that's actually the same price as the S, because there cannot be a difference. But if FT is higher than the spot price or the futures price in that moment, he gains. In the other case, he loses from the hedge. Looking at the situation of the miller, he is short in the wheat. He needs to buy it in October and he would be happy if the price was low. For him, the same value as T plus 1 is a cost. The whole expression that we are going to create is a cost. For the farmer it was a revenue. For the miller it is a cost. Please note that we are always talking about the same as T plus 1. Since he is long in the futures, he will buy wheat at price FT, and he will sell the futures at price FT plus 1, which is the same price at expiration as the spot price. So if FT is higher than FT plus 1, he will lose on the futures, and he will win on the futures if FT is lower than FT plus 1. Now let's look at the scenarios with numbers, starting with example 4.9. We will analyze two situations in time 1. Either the spot price for wheat goes up to 80 or it goes down to 60. Right now, the spot price is 70 per ton and the October futures price is 73.50. That price is fixed and it won't change. Let's look at this from the perspective of the farmer. The farmer knows he will have 500 tons of wheat to sell in October, and is of course hoping for a high price. If that happens, his revenue will be 40,000. If the price goes down, his revenue will be only 30,000. To protect himself from declining prices, he will go into a futures position, the futures short position, to sell futures for 73.50. He will close that out. Actually, it will be expiring either at a price of 60 or 80, so he has to buy spot for 60 or 80. So if the price goes down, his futures position is worth 13.50 per ton, which adds up to 6,750, which means if the price in the spot market goes down, he makes an extra 6,750 in the futures market, so his total revenue is 36,750. On the other hand, if the price goes up, then he's happy about the spot price being high, but then he loses on his futures position, and he loses 6.5 euros, and that will then reduce his overall revenue to 36,750. Whatever happens in this, what we call perfect hedge, he will sell his wheat at 73.50 per ton. So he is not really affected by the probable price changes in the wheat in the spot market. He will always have that price, and this is the price that the futures had in time 1 in March when he entered the futures position. Now let's look at the perspective of the miller. The miller knows he will need wheat in October. He is in a short position with regard to wheat, and he would hope for low prices. If that happens with a low price, he will buy for 30,000. If the price is high, he will buy the 500 tons for 40,000. So he goes into a long position in the future to protect himself from increasing prices. If the prices increase, he will make some money on the futures position. So his overall cost is 36,750. If the price is low, if the price goes down, he will lose with his long position in the futures, so he will lose 6,750. His overall cost will be 36,750. Whatever happens to the wheat price, his overall cost is 73.50 per ton. To put this all together, with a perfect hedge, the price at which an item was sold or bought will always be exactly the futures price at the time the contract was started, in time t. In case of an imperfect hedge, it wouldn't work like that. An imperfect hedge occurs if futures contracts won't expire on the same day as the position being hedged. In a situation like that, futures contracts would be bought or sold which expire later than the position being hedged. So let's say it is the month of October. That would be time t. A manufacturer will have to buy copper in February, which we denote as time t plus 1. Matching futures are not available, so he enters into futures which expire later than February, let's say March. Since he is short in the copper, he goes long in the futures. Therefore, such a position is called a long hedge. At the time he buys the copper in the spot market, he will also close out the futures position. That would be in time t plus 1. The cost of the copper will be st plus 1, and he will either gain or lose on closing out his futures position. In this situation, with long futures, he buys at price ft. Remember, long futures means buying something forward. So he buys at that price ft, and he closes the position. That means he's selling the same thing at price ft plus 1, the price in February. So either he will have a loss from the hedge or a profit from the hedge, depending on the difference between ft and ft plus 1. A short hedge works as a mirror image of the long hedge. Let's say it is March, The farmer wants to sell his wheat in August, but August futures are not available, so he enters in September futures. A short futures means selling at price FT, so the FT in this case is a revenue, and closing out the position, the minus FT plus 1 is reducing that revenue. So either he will win or lose when closing out the futures position. Remember that the price ST plus 1, the spot price of the wheat in this case, is a revenue. This guy is selling his wheat, so the price ST plus 1 for him is a revenue. At any given time, we can determine the difference between the spot and the futures price. This difference is called basis. Since futures are marked to market on a daily basis, there is a gain or a loss to the position every day. The risk that arises from the change in the spot and the futures prices to the overall position is called basis risk. So for that, let's look at some pictures. At time t, the spot price is 7. And the futures price, FT, for delivery in time capital T, is 10. The basis is therefore -3. It's 7 minus 10. Let's assume that at time t plus 1, the spot price has increased by 2, and the futures price for delivery in T has increased by 4. The basis now is -5. A trader in a short hedge is long in the underlying and short in the futures. His long position in the underlying gains 2, but his short position in the futures suffers. He loses 4. Overall, he will lose 2. The trader short in the underlying is long in the futures. His short position loses 2. Well, the short position, the trader short in the underlying, means he would be happy if the prices go down because he has to buy these things. But the prices go up. So therefore he loses 2 compared to the price in T, but his futures position wins 4, so his overall gain is 2. Let's look at how the basis has changed. It goes from -3 to -5. The absolute value is lower. On an imaginary number line, -5 is left from -3. We call such a situation a weakening basis. As you can see, the weakening basis situation is bad for the short hedge and it's good for the long hedge. Now, let's look at the situation we call strengthening basis. At time t, the spot price is 7, and the futures price FT for delivery in time capital T is 12. The basis is therefore 7 minus 12 is -5. Let's assume that at time t plus 1, the spot price has increased by 3, and the futures price for delivery in time capital T has increased by 1. The basis now is 10 minus 13 is -3. A trader in a short hedge is long in the underlying and short in the futures. His long position in the underlying gains 3. He is happy about increasing prices in the spot price. But his futures position goes also up, but only by 1. Where he loses 1. So the short position in futures loses 1. In total, the short hedge gains 2. The trader short in the underlying is long in the futures. His short position loses 3 and his futures position wins 1, so his overall loss is 2. Let's look again how the basis has changed. It goes from -5 to -3. The absolute value is getting higher. On an imaginary number line, -3 is right from -5. We call such a situation a strengthening basis. Let's look quickly at two more examples so you don't think this logic only applies when prices increase. This time we have a situation where the prices decrease both in the spot price and in the futures price. In time t, the spot price is 10 and the futures price is 15, which, by the way, is a normal scenario. It is what we call contango, if the futures prices are higher than the spot prices. The basis is 10 minus 15 is minus 5, negative 5 at time t, which means for a trader who is long in the underlying, he is not so happy about the decline in the spot prices because he loses 4. For protection, he has a futures contract, a short position in futures. The price goes down, so he wins with the futures. The price goes down, so he wins with the futures, but only 1. So he loses 4 in his long position in the underlying. At the same time, he wins 1 with the futures, so the short hedge loses 3. A trader who is short in the underlying, who needs to buy the underlying in time t plus 1, he should be happy about the decline, and yes, he has a gain of 4 compared to the price in t. The long position in the futures loses 1 because the price of the futures goes down, so the long position in futures suffers, but only by 1. So the long hedge in total gains 3. Let's look at the change in the basis. The basis goes from negative 5 to negative 8. That would be going to the left on an imaginary number line. That basis is called weakening. So the last example is about a strengthening basis. We have a spot price of 7 and a futures price of 12, both in time t, and that makes a basis of 7 minus 12 is negative 5. So both prices go down. The price for the underlying goes down by 1 and the price of the futures goes down by 2 until time t plus 1, where everything is settled. Actually, the futures would go until time capital T, but the trader closes out his futures position. If the trader is in a long position in the underlying, he's unhappy about the decline in the spot price. He loses 1. Long position in the underlying is protected by a short position in the futures, and a short position in the futures profits from declining prices by 2. So the short hedge gains 1. If the trader is short in the underlying, he wants to buy the underlying later, so he's happy about declining spot prices. He saves 1, but he loses 2 in his long position in the futures, so his overall loss is 1. Let's look at the basis. What is the basis doing from time t to time t plus 1? The basis is going from negative 5 to negative 4. The basis is actually strengthening by 1. For each situation, a long hedge or a short hedge, if the hedge is not perfect, there is basis risk. The movements in spot price and futures price may be favorable or unfavorable to the trader. We have to be able to analyze the situation, and we do this with a standardized format to be found in the text with all the examples, starting at page 49 with example 410. In example 410, the basis does not change. This means the loss that the trader has in the underlying, in this case the milk, is exactly offset by the gain in the futures position. As you can see, underlying price and futures decrease by the same amount. In time t, the spot price is 13.20, and we assume that the price in time t plus 1 is 12.20, so it goes down by $1. The futures price in time t is 12.75. It goes down also by $1 to 11.75. The basis in both times is 45 cents. So the basis does not change. Let's put that together in a standardized table. So the table would look like this. We have the long position for the milk and the price in time t, same for the price for the future, and the prices in time t plus 1 one's for the milk, and one for the futures. So now, he's long in the milk. He's a seller of milk. So from 13.20 to 12.20, he will lose $1. With the futures, he is short, so he profits from declining prices. The price for the futures goes from 12.75 to 11.75, so he's actually winning $1. So the dollar that he wins is the dollar that he loses in the spot transaction, which means the basis doesn't change, and that also means he's actually selling at a price of 12.20, plus he's winning $1 in the futures position. If we put that together, he's selling the milk in total for 13.20, and that would be the price that he had in the beginning, in time t. Obviously, with a basis that stays unchanged, his net hedge is the same price as he would have had in time t. So let's look at a second example. That would be 4.11, a short hedge again, with a weakening basis, which results in a loss for that position. Let's quickly look at the data. It's the month of May. A milk producer intends to sell his milk production in August, time t plus 1. August futures are not available, so he goes into September futures. So let's look at the prices. The price for the milk in time t is 13.20. That is the price we had before. And the futures price is 12.75. So the basis is 45 cents. We had this before. In August, we observe a price for the milk of 11.90 and the price for the futures of 11.75. Now the basis is 15 cents. So let's put that together in our table. The milk goes from 13.20 to 11.90. Since he's long in the milk, he loses 1.30. He is short in the futures to protect himself from declining prices because the short future profits from declining prices. So the price goes down from 12.75 to 11.75, which gives him a plus of $1. In total, he loses 30 cents. If we compare the basis, we see the basis is going from 45 cents to 15 cents. That is actually going to the left on an imaginary number line. The basis is weakened. Please note that in this example, we are looking at an unusual scenario with what we call backwardation. The backwardation implies that the basis is positive. Usually it would be negative. But still, going from 45 cent to 15 cent is going to the left on an imaginary number line. So that is weakening of the basis by 30 cents. Let's look at the situation when the basis is strengthening. Again, the milk producer, again the price of 13.20, again a futures price of 12.75. So now the price goes up to 14.45 in the spot market, and the futures price goes also up to 13.60. The basis before was 45, the basis in time t plus 1 is 85 cents. So let's put that together in the table. We have the long position in the milk going from 13.20 to 14.45. So he actually wins 125 in the spot market. His short position in the futures that was supposed to protect him is now running against him because the prices are increasing. He's losing 85 cents. So he's winning more in the spot market than he's losing in the futures market. The basis is going to the right on an imaginary number line. It goes from 45 cents to 85 cents. It's strengthened by 40 cents. For a short position, for a short hedge with the basis strengthening results in a profit. Example 4.13. Now a long hedge with a weakening basis which will result in a profit. Let's look at the manufacturer. He needs to buy copper in the future. He's short in the copper. Let's look at the prices and let's put them right away into the table. He's short in the copper, so he's actually happy about a decline in the price from time t to time t plus 1. It's 20, so that's his gain. He buys to protect himself futures, long position, which would bring a gain if the price was going up. But the price is going down, so with the futures is losing 10 cents. Overall, the basis here is 20 cents. It goes down to 10 cents. That would be a weakening basis by 10 cents. Overall, what he wins in the spot position, he loses a little bit in the futures position, so overall his profit is 10 cents. His overall cost of the copper is 380. Now that's a cost, 380 minus the 10 cents that he's making in the futures. Since he is short in the copper, these prices are cost to him. So he needs to buy the copper for 380. That's a cost for him. And unfortunately, he's losing 10 cents. So how is that a profit overall? He has a price to pay of 380 and he loses 10 cents on the futures. Well, now his overall cost is 390, and that is 10 cents better than what he would have paid in time t. That is like a better price than he would have had in time t, a better price by 10 cents. Let's look at the final example here. For 15, it's a long hedge. The basis is strengthening, which will result in a loss. The manufacturer needs to buy copper. We had this before. Let's assume the spot price right now is $4. It is in time t plus 1, 380. It's lower. He should be happy. The future prices goes from 410 to 370. Let's put that together in our standardized table. He's short in the copper, which means he would have paid 4. Now he would have to pay 380. That makes him actually a little bit happy because he saves 20. But his long position in the futures loses 40. The futures goes down by 40 cents. That gives him a loss of 40 cents. So overall, he's losing 20 cents compared to the price that he would have paid in time t. So let's look at the basis and the change in the basis. That's actually a little bit interesting because right now we have a basis that is negative. S minus F is negative 10 cents and it goes to positive 10 cents. So what does that mean? It goes from the negative part on an imaginary number line to the positive part of an imaginary number line. It goes to the right. That means the basis has strengthened by 20 cents. In the examples, just as in the exercises, we will have the 4 prices given, and we have to determine if the trader wins or loses in the underlying and what he wins or loses in the futures. Then we also have to determine the basis and the change in the basis. From the data in these tables, we obtain everything we need to know in order to determine the net hedge, so either the revenue or the cost to the trader. We can do this in 3 equivalent ways, and we have to look how we can derive these calculations. For this, we have to go to page 47 in the text. In this case, for simplicity, we use only time 1 and time 2, so it doesn't look so weird. Time 1 is today, when the trader enters into a futures contract, and time 2 is the time when the futures position is closed out and the transaction in the underlying is carried out too. Now we have situations for a trader who is either in a long hedge or in a short hedge. In a long hedge, so let's look at this. In a long hedge, since the trader is short in the underlying, all the variables we look at is a cost to him. He will buy the underlying at price S2. Since he is short in the underlying, he is long in the futures. So the long futures he will buy at price F1 and he will sell this at price F2 to close the position out. So his profit will be F2 minus F1. If F2 is greater than F1, it is a gain for him, and lowers his overall cost for buying the underlying. If F2 is lower than F1, it's a loss for him, and this will increase his overall cost for buying the underlying. So we can put that all together to get the total cost of the asset in time T2, and that would be what he pays for the asset and his additional cost or less cost from his for a futures position. For the short hedge, since the trader is long in the underlying, all the variables we look at is a revenue to him. A short hedge means he is long in the underlying. The trader might own the asset and he will need to sell it in time 2 at price S2. So that is his revenue. In order to protect himself from decreasing spot prices, he will enter a short position in the futures. Therefore, he will sell at F1 and he will buy at F2 to close his position out. If F1 is greater than F2, it is a gain for him and it will increase his overall revenue from selling the underlying. If F1 is lower than F2, it's a loss for him, and this will decrease his overall revenue for selling the underlying. The net hedge, which is either a cost or a revenue, can be explained in 3 equivalent ways. The hedge position, no matter if it is interpreted as a cost or a revenue, is always ST plus 1 plus FT minus FT plus 1. We just have derived that in the 2 sections above. So ST plus 1 plus FT minus FT plus 1 is either a cost or a revenue. It is a cost in case of a long hedge, and it is a revenue in the case of a short hedge. So if we rearrange those variables, we can also simply change the order of the variables and we get this. We can also expand this expression by adding ST 2 times. One time as plus ST and one time as minus ST, so that the net effect of this is 0, in which case we will have this. So if we interpret this right, then we'll see the first expression, FT plus the difference between S and F at time T plus 1 is nothing else but the futures price in T plus the basis in time T plus 1. That would be one way of showing the net hedge, either his total cost or his total revenue in time T plus 1. But we can also show it like that. It's the spot price in time T plus 1 plus his gain or minus his loss from the futures position. That would actually be the most intuitive to understand. He's buying or selling at price ST plus 1, and then he's making or losing something on his futures position. We can also interpret the net hedge as the spot price at time T and then the change in the basis, because this expression here is nothing else but the basis in time T plus 1 minus the basis in time T. And these would be the change in the basis. All of these 3 equivalent ways are employed in the examples and the exercises, because the net hedge is always being determined with either the first one or the second one or the third one to show this. In summing this all up, being in a long hedge with a basis strengthening, that will result in a loss. Being in a long hedge with a basis weakening will result in a profit. Being in a short hedge with a basis strengthening will result in a profit. And being in a short hedge with a basis weakening will result in a loss. All those 4 situations are possible, and we need to be able to identify each of those situations. The last thing we have to do today is to look at another case of an imperfect hedge, and that would be if futures for the asset being hedged are not available. In this case, the trader may look for another asset whose price and risk characteristics are similar to the asset that needs to be hedged and for which futures are available. A situation like that is called a cross hedge. If the futures are not the same as the asset to be hedged, we have to ask ourselves, how many futures contracts should we buy or sell? For that, the first thing we need is what we call a hedge ratio. Let us derive this. It's a little bit math, looks a little complicated, but actually it's not so much. It's pretty straightforward. Let's look first at page 57, which is here. So 57, and what we need is the variables that we need to look at. So keep in mind we are looking at one asset which has a spot price at any given time, and we look at the futures price of a different asset. Then we need to look at the random variable that is of interest to us, which is the change in the spot price at any given time, and we need the change in the futures price of that other asset, which is both is denoted as delta S and delta F, as it stands for a difference of a value. Then we need the standard deviation of that delta S and the delta F, which is the sigma. That's a standard deviation that's typically abbreviated as sigma, sigma S and sigma F. And we need the correlation coefficient delta S and delta F. The correlation coefficient between -1 plus 1, and it is a value that gives us an idea of how similar these two random variables behave. If it's negative, they sometimes go in different directions. If one goes up, the other one goes down. If it's positive, then they both go up most of the time. If it's exactly +1, it means those two variables are actually going up at the same time or go down at the same time. If it's -1, totally negative correlation, it means they're always going in opposite direction. So then we need to do some calculation. So for a trader who's long, let's say a trader is long in the underlying asset and short in the futures. His position at any given time, because of the marking to market thing, is S minus F. So that's his position at all times in each time t, which implies that one futures contract short is entered per one unit of underlying asset long. But these assets are not the same, so the one-to-one relationship is nothing that we should assume. So let's replace, or let's include, a variable h, which is the number of futures contract per one unit in the underlying. The number of futures contract per one unit in the underlying. So we change the equation a little bit. So then what we have here is the wealth, the position of that trader at any given time. But the hedger is not looking to maximize a wealth position. He needs to minimize the risk, the variance of that. And to be more precise, he needs the variance to minimize in the change of the total position. And that would be the delta P and the delta S and H times the delta F. So therefore we make that the expression, the variance in his change of the position, is nothing else but the variance of that what his position is about, and that is to be minimized. How do we minimize a function? By taking the first derivative. How do we minimize a function? How do we find the minimal value of a function with regard to a certain variable? Well, by taking the first derivative, and that's what we do. So we differentiate the portfolio position with respect to h. So we have a footnote, and that footnote tells us the variance of a sum of two random variables is calculated as this here. This actually is nothing else but sigma s squared plus h squared sigma f squared minus 2 times h. And this expression here, by the way, is nothing else but the covariance, sigma s, sigma f, times the correlation coefficient of s and f. That would be this covariance here. So then we take the first derivative with regard to h, and that gives us this expression. Then we equal that to 0 to find out where the minimum is, and then we find, if we solve this for H, this is in the numerator is the covariance, and in the denominator is the variance of the futures change. The covariance in the numerator, we will have the covariance between the change in the prices in the underlying asset and the futures on the other asset, and in the denominator we have the variance of the change in the futures price. That is pretty much a beta. That is a beta as we know it from the capital asset pricing model. So that's basically the same idea. It's nothing really new. Then we can cancel away 1 sigma f, because the covariance is actually this here. And what is left over is the optimal hedge ratio is the two risks, the two volatilities divided by each other, and that multiplied with the correlation coefficient. That is our result for now. That is the optimal hedge ratio. Let's look at it at an example. A trader has a holding period of 2 months for commodity A. The standard deviation of spot prices of commodity A over 2 months is calculated with 18 cents. The standard deviation of the spot prices changes actually is 18 cents on the average. And the volatility of the futures contracts, and that would be for commodity B, since we have a cross hedge, is 29. Which also means by looking at it, you could already say, the futures price is obviously a little wilder, going up and down than the asset price, commodity A. The correlation of the two is 85%, which means most of the time they go in the same direction. So they are pretty similar. The optimal hedge ratio is therefore easy to calculate, 0.18 divided by 0.29 times 0.85, and that would be 0.53. Just let's play around with this a little bit. Let's say those two assets, commodity A and commodity B, would be totally similar in their ups and downs. If that was the case, then the correlation coefficient would be 1. And if that is 1, we can simply take 0.18 divided by 0.29, and that would be 0.62. That means we would only need 0.62 of the size of the position of the asset to protect it. Why? Because obviously the asset that we use to protect ourselves, the future on commodity B, is wilder. It goes more up and down, so we don't need that many. We only need 0.62 of the position that we have in the asset. But they are not totally going in the same way, so we take a little less, and that would be 0.53. Then we still do not know how many contracts we need, so we have to do an additional calculation to determine the number of contracts, and we will do that with our next example. This example is taken from Professor Hull's book, Option Futures and Other Derivatives. Professor Hull is a very renowned professor for derivatives and risk management. He wrote that very famous book that actually almost everybody uses who is teaching or trying to learn something on this, and edited a little bit. So it's not exactly as it is in Professor Hull's book. So let's assume an airline intends to purchase 1 million gallons of jet fuel in 1 month, and that jet fuel futures are not available. It may want to hedge the price risk using heating oil futures. Maybe the heating oil futures go a little bit like the jet fuel prices. Each contract is for delivery of 42,000 gallons of heating oil. So then the airline calculates data and collects data maybe from 12 months, of actually 14 months, or 15 months. We have months from 1, 2, 3, 4 until 15, and we have changes, the percentage changes in the prices of the jet fuel and the heating oil futures. And they have collected this. And as you can see, month 1, both go up, month 2, both go up, month 3, both go down, and so on, and so on, and so on. And it seems that only for month 10 the price for jet fuel goes up when the price for heating oil futures goes down. So that is 1 month where they don't go in the same direction. Then I use Excel's functions to determine for a sample the standard deviation and the correlation coefficient. So I'm not doing this myself. I let Excel do this. And since this is taken from an Excel sheet that I prepared, we have the formula here, and it says the standard deviation for the jet fuel price changes is 2.63%, and the volatility in the heating oil price changes is 3.13%. And the correlation is very, very high, as we have already seen by looking at the data. It is very close to +1. It's 0.928. And with that, we can now use our hedge ratio formula, which is very simple. We just plug in the numbers that we have determined. We have 0.0263 divided by 0.0313 and multiplied with 0.928, and that is 0.778. So that would be our hedge ratio. But heating oil contracts is delivery of 42,000 gallons. So how many contracts would we need? We would need 1 million divided by 42,000, and that would be 23.8 contracts. This is actually the formula that we had before. Here, this one. QS is the size of the position of the asset being hedged, and QF is the size of the futures contract. And that is what we did here. 1 million is the number of gallons that are needed, and 42,000 is the size of one contract, so we need 23.8 contracts. But we can't buy 23.8 contracts, and on the other hand, we don't need that many because we only have a hedge ratio of 0.778. So we have to multiply the hedge ratio with the number of contracts that we need, so we come to 18.52 contracts which are not available. So we will go and round that to the nearest whole number and take 19 contracts to hedge that risk. We are at the end of this session. In later sessions we will also have to look at a few exercises which have already been uploaded. Keep in mind that most exercises reflect the complexity and structure of the problems that we will have in the exam. Any questions can be sent via email either to my standard CBS email or to w.heinrichson@gmail.com.